Namaste to all. I, along with my Vice Chair Abhay Chajerji, welcome everyone on this another webinar. Do you know series? A very important series, basically on the financial statements for the non-corporates and LLP, that is the proprietorship partnerships and LLPs. In the first series, we had discussed about assets, and this webinar will be discussing upon the liabilities. For this, we have got two very important dignitaries, two important panelists. One among them is CA Parveen Kumarji, a very well-known figure in the fraternity who has ever dealt with Ind AS, I would say, accounting standard as well as Ind AS. So he has been one of the first teachers of our Ind AS certification course of the ASB, and has always been a regular contributor to the institute on various matters of accounting and audit. So I welcome you, Praveen Kumarji, for being there as a panelist for this very important session.
Thank you so much.
And, thank you, sir. And the second person which we have is our own council member, the first time council member from town Vadodara for the first time. And those who know him from that region, of course, everyone knows him from the western region. But currently, he is the chairperson of the Board of Studies Academics. That is the person who has brought in the correct syllabus with lot of. Thank you, Vishal Bhai, for bringing that for the benefit of all the students and for the ICI. And another very important board which is vice chairing is the Audit and Assurance Standards Board. But another one which he is heading is a very, very important directorate, I would say, the Center for Audit Quality. So any of us who are having this
you have to unmute, Pramod bhai.
Yes. Any of those who are having who are into assurance practice must be fully aware and known about this, that the Center for Audit Quality, which is there of the institute, he is heading, Vishal Bhai, and he has done a tremendous job into that and given so many of the templates, so many of the software, so many of the Excel sheets, like materiality, like your recently the engagement letters. You just to get them letter. So and various qualifications noted by various companies, a lot of material there. I'll be just feeling short of words if I tell whatever is there is being done in the CAQ. But most importantly, if we see this formats for the financial statements for this non-corporates, it was the brainchild of Vishal Doshiji, which was aptly catched by our Vice Chairman Abhay Chajerji that we should do it. And then, of course, he had already done some work over it in the past years. Under his convenership, we had that group which formulated the technical guide and the guidance note for the financial statement for the non-corporates and the LLPs. And thank you, Vishal Bhai, for giving such a beautiful thought process, which would be adopted throughout the country for standardization of the financial statement formats. Thank you, Vishal Bhai.
Thank you.
And of course, to moderate these two, we have to these Star Worlds, we have another Star World who was there even for the initial Do You Know series for the assets, CA Rajesh Kumar Jain, who is from Ludhiana, the past chairman of the Ludhiana branch, and of course, who has done his certification course on Ind AS and many other courses, and regularly contributing, and even for this guidance note for the financial statements also, he was a part of that group and a regular contributor. Thank you, Rajesh Bhai, for joining and agreeing to moderate this. And of course, our Vice Chair, C. Abhay Chajerji, who has been pioneer in ensuring that these, not only the guidance note, but also creating awareness about these financial statements through your Do You Know series. So I now hand over to my Vice Chair, Abhay Chajerji, to please take it forward from here.
Thank you very much, Pramod Jainji, the chairman of the Accounting Standard Board. And of course, I would even further add the convener of very important directorate, which is of ICI, is the members and students section. So that has been taken care, which where we got implemented the Know Your Member this year, where I'm sure every participant who's here today has already done it. And we've got huge response. The compliances have been done from the members, and it was from all the participants. We got the KYM done, and I think that is a remarkable effort which the chairman ASB Pramod Jainji has done this year by implementing this entire process. So thank you, Pramod Jainji, and of course, very important eminent personalities and speakers for today's webinar. The series which we decided a few days back in the ASB that we should have it. And I think one of the best persons, I would say, two important people which we can have is Praveen Kumarji, who's been like always available. I must say, thank you, Praveenji, for for every I would say initiative which ASB has taken in past, whether it's a webinar series or where it's group discussions, where it's a board meetings of the ASB. All I think you've been contributing so much for past so many years. I think we must appreciate and thank you so much for being here again today. Vishal Bhai, of course, Pramodji has already shared the way he's been doing and taking things at ICI and initiating from students till the members to ensure quality at all levels. I think kudos to Vishal Doshi, and thank you so much, Vishal Bhai, for joining. And of course, the moderator, Rajesh Bhai, thank you again. And the office would not take much time because we have our experts, but quickly, the idea of having this webinar series created was the guidance note, which is released by ICI last year. And of course, now been decided that it would be effective from 1st April 2024 on the formats on the financial statements, which is applicable for non-corporate entities and LLPs. So this is very important series because the basic understanding, the presentations, the framework, which all been discussed here today. Yesterday, we had, a couple of days back, we had the assets, which was taken care. Today, we have the liabilities, where entire liabilities. I would say that being non-corporate entity, still there is so much to know how it has to be presented, how it has to be measured, recognized, and then disclosed will all be discussed today. And we have income and expenses, which we'll be covering tomorrow. And again, we have a webinar series on 28th. So I would request every participants today that those who have missed in past on any of our webinars, it's already hosted on ASB website. It is available on ICI TV, and going forward also, if we have today and tomorrow and day after, if you miss any of those sessions, because these are all relevant and important sessions, we would sincerely like that you can go to this website of ICI on the ASB or even at ICI TV. You can have those recordings. Quickly, lastly, I would say that the formats are already hosted on the ICI website and ASB website. So those who have still not downloaded or may have not got a chance to look at the Excel formats, these are readily available. Please have it downloaded. The non-corporate entities, LLPs, and even a technical guide for non-profit organization has been released where we have the Excel formats. So this is all available on the ASB website, which will be very useful. And you can make best use of these formats, send it to the preparers and ask them to start preparing their financial statements in these formats, which is the format will be acceptable after 1/4/24. So thank you very much, all of you, for joining, all the participants. And I'm sure this 1.5 hours of learning, we'll have a lot of learning from the experts. And we'll, if there's still any questions which are left, we'll be happy to receive in the chat box. And then we can take them at the time maximum available, or otherwise be able to respond later. Thank you very much. So over to you, Rajeshji. Thank you very much.
Thank you, sir.
Thank you, everybody. Over to Rajesh.
In the beginning, I would express my heartfelt thanks and gratitude to CA Pramod Jainji, Chairman ASB, and CA Abhay Chhajarji, Vice Chairman ASB, for giving me this opportunity to be part of the second webinar on Do You Know You series on financial statement of non-corporate entities and the LLPs, where the two stalwarts from our profession, CA Vishal Doshi ji, Central Council member, and CA Praveen Kumar ji are the keynote speakers. As we all know, the ICA already issued 2 guidance notes during the month of August 23. One guidance note on the financial statements of non-corporate entities and another guidance note on the financial statements of limited liability partnerships. Accounting Standard Board has already held one first webinar on the Do You Know series on financial statement of non-corporate entities and LLPs, where Dr. Avinash Chandraji and CA Dimpy Khandarji were the eminent speakers. The topic covered in the first webinar was recognition, measurement, and presentation of assets. Today is the second webinar on Do You Know series on the financial statement of non-corporate entities and LLPs, where Shri Vishal Doshi ji, Central Council member, and CA Praveen Kumar ji will take us through the recognition, measurement, and presentation of liabilities, which would also include the equity and the honors funds. Now, I would request CA Praveen Kumar ji to start with the first thing in the liability side, how the term equity has been defined as per the framework for the preparation and presentation of financial statements already issued by ICA.
Yeah, thank you very much, Pramod ji, and thank you, Abhay ji. I think sharing dais with Vishal Doshi ji is an honor by itself. The person who made all that guidance note, how can I speak in front of that person? So you are already there, sir. You have got all the answers. But thank you for giving me this opportunity. And thank you, Rajesh ji, for straight away asking the question. I think the format of this webinar is very, very interesting. Instead of one person making a PPT and then sharing thoughts, I think once we do it in this manner, question and answer manner, the speaker also remain alive, and B, the audience also, they are curious what is the answer to this question. And most importantly, I think, Pramod ji, the way you have structured it, all the questions which are in mind of small and medium practitioners, all the questions, whatever they can think of about gratuity, about equity, they all will get addressed in these, in this series. I think this is a great help, and it's a great work for small and medium practitioners. Kudos to our Accounting Standard Board, Pramod ji and Abhay ji, for making this initiative. So Rajesh ji, I know him for in seminars also he asked very difficult questions. So so straight away answering the question. But before
Actually, Praveenji, Ludhiana is known for this. So I always tell to all speakers, you have to go to Ludhiana. You have to prepare very, very strongly to go to Ludhiana.
Yeah, I know Mr. Jain for that only, because he will make sure that the people who are presenting, they know their topic well. So thank you, Rajeshi. Before coming to your question, I would like to share with you that in 400th meeting of council, which was done in March somewhere in 2021, the institute brought out this announcement where applicability of accounting standards were divided into different levels: level 1, 2, 3, and then 4. And when we look into the accounting and various issues, whether it is asset liabilities or income recognition or expenses, I think we must keep that in mind, that there are different levels. What we studied in when we were preparing for CA exam, the things were different, but now there are different levels. So these levels have different kind of exemptions from different standards. So this has to be kept as a background or on the back of mind when we are looking into these issues. And also, I would like to, make a statement which we make generally in all these kind of webinars, and Vishal Doshi bhai will agree that whatever we will share will be our individual personal opinions. So any view which you are, as audience, you are taking while, dealing with the real life situation, we strongly recommend that, go through the literature which has been officially issued by the institute. These webinars are just, they are just showing you the way, we're giving you some kind of guidance. But don't take these as official literature of the institute. That's published literature. So I recommend that whenever you are taking a call, Don't say that I took this call because Praveenji said in the webinar like this or Vishal Doshiji said like this. Always take literature as the base of your final call when you are taking. So, going to the question which Mr. Jain has asked, it is very, very clear. The framework defines all the components of financial statement. And equity is also one of the component, and it is one of the most important component. It cannot happen that any framework is prepared without defining the equity. So what I have with me right now is a guidance note, and I also have this compendium of these accounting standards, and also some of the literature which has been issued by the institute, some of the literature which has been issued by the income tax department. So we will go through these guidance notes. Guidance note which was published in August 23. Before that it was a technical guide. The guidance note has been inspired from that. So the framework, so in the guidance note, when you refer to page number 10, it clearly mentions that the framework has defined equity, the elements which are directly related to measurement of financial position are the assets and liabilities and equity. So basically equity is a residual value, which is residual interest in the assets of the enterprise after deducting its liabilities. So if you calculate all the assets and reduce the liability, whatever is left is the equity. This is how the framework defines equity. So when we are talking about non-corporate entities or LLPs, so to define equity, this is the way framework has defined. So you calculate the total of assets, reduce liabilities from there, and whatever is left is equity. So this is how the framework has defined. So answering your question, yes, framework has defined the equity, and then going into detail, this is defined like a residual interest. Over to you, Jain Saab.
Thank you, sir. Thanks a lot, sir, for defining the equity as per framework for the preparation and presentation of financial statements. Now, today's webinar is on recognition, measurement, and presentation of liabilities. Vishal sir, what is the meaning of a liability? And then there are two kinds of liability, a current liability and a non-current liability. And what is the criteria to classify a liability as a current liability as per this guidance note?
Thank you, Rajeshji, and a very good evening to all the, I would say, experts and the dignitaries on screen, and also the participants to have joined this very unique Do You Know series on the financial statements of non-corporate entities and LLPs. At the outset, my compliments to Pramod Bhai, the chairman of the Accounting Standards Board, as well as Abhay Bhai, the vice chairman of the Accounting Standards Board, for I would say coming out with this guidance note in a shortest possible time. In fact, it is less than 2 years since this council has taken over, and we already have the technical guides on this that were released last year. And I think this year also, in record time, they have come up with the guidance note on this format of financial statements for the non-corporate entities as well as the LLPs. And I would like to thank them for giving me an opportunity to lead this and come out with this literature in the shortest possible time. In fact, Parveenji, I would say I am privileged to share this webinar with you, because you have been a stalwart. You are a very active participant at the AASB, also the Auditing and Assurance Standard Board, and your contribution is immense to the profession. So thanks for being here, and I would love to hear your responses on the questions. And special thanks to Rajesh Bhai, who was there as part of the group when we were formulating this technical guidance note. And like Pramod Bhai mentioned, he knows the ins and outs, and definitely interacting with members regularly, he knows the pulse of the members and what are the difficulties or the questions that members face regularly when it comes to the audits of the non-corporate entities and LLPs, and that, like rightly said, it can be seen from the question bank that has been shared with us. So once again, a very good evening, and thanks for this opportunity to share my views. And like Parveenji said, yes, very rightly.
विशाल भाई बड़ा सिंपल सा एक वो फैक्ट है, वो कहते हैं तेरा तुझको अर्पण क्या लागे है मेरा, आपने तैयार किया आपको ही दिया, हमारा क्या गया। आप ही बेस्ट किया था स्टार्ट फॉर दिस ऑल गाइडेंस फॉर प्रोप्राइटरशिप पार्टनरशिप।
No, thank you, Pramod bhai. So nice of you, so humble of you. And like Parveenji mentioned, I also would definitely share that whatever views we are going to express, they are our personal views and not of the institute, of the council, or any committee thereof. So please consider in that spirit. So coming to the question about liability, what exactly is a liability? Very nicely explained by Parvinji about the equity, and where he mentioned that the assets minus liability is the equity, the residual value. And what is a liability? So the liability is the financial obligation of an enterprise other than the owner's fund. So this has been defined in the guidance note on the terms used in financial statements. This is an ICA guidance note where they say that liability, it's a financial obligation other than the owner's funds. So the owner's funds is also an obligation, but other than that, whatever is there, the obligation, the financial obligation, that would become a liability. And like Rajeshji mentioned, that liabilities would be two, the classification into current and non-current liability. So when we talk of current liability, there are four conditions which are there, four criteria which are there. And if the amount, the liability satisfies any one of the criteria, then it would get classified as a current liability. So the first criteria is that the liability is expected to be settled in the entity's normal operating cycle. So operating cycle of an entity, if I would just take a minute to explain, is right from the time the entity procures its raw material. So it would procure the raw material. If it is a manufacturing unit, it would convert that into finished goods. Then it would sell that finished goods. From the sale, the collection would be realized. So right from the time of procurement till the time of collection, this whole time frame is known typically as an operating cycle. In a layman's term, I'm trying to explain. So whatever is the time period of that is known as the operating cycle. So if a liability is expected to be settled within the entity's normal operating cycle, then it will become a current liability. The second criteria is that if the liability is held primarily for the purpose of being traded, then it would become a current liability. The third criteria is that if it is due to be settled, if the liability is due to be settled within 12 months after the reporting date. So typically in most of the non-corporate entities and LLPs, we would have 31st March as the reporting date or the closing date. So if any liability is to be settled within 12 months from 31st March of the year of the balance sheet date, then it would become a current liability. And the fourth condition or the criteria is that if the entity, it does not have an unconditional right to defer the settlement of the liability for at least 12 months after the reporting date, then it would become the current liability. So any of these four conditions getting satisfied, the liability would become a current liability. So back to you, Rajeshji. This was the response to the question.
Sir, would you explain something about this liability where we have unconditional right to defer settlement of the financial liability? This is the fourth limb of the term current liability.
Right. So see, many times I would give a very simple example in case of a bank loan, especially, and let us say that there is some condition with respect to that loan. I'm just giving an example that it is in the nature of a term loan, a long-term loan, and there are some conditions which are attached to that term loan. Now, if the entity it does not satisfy or does not meet the condition one or more of them, and as per the agreement, the loan would become repayable on demand if certain conditions are not satisfied or they are violated. And if the entity, that is the borrower, the non-corporate entity, if it does not have an unconditional right to defer the settlement, right? So here it becomes suo moto that as per the agreement, if the terms and conditions are violated, then the loan becomes repayable on demand. Then in that case, this term loan where the borrower or the entity does not have any unconditional right to defer the settlement of that liability, then it would become a current liability. So this was just one example in which the long-term liability can become a current liability where there is no unconditional right to defer the settlement beyond 12 months from the reporting date.
Thank you, Vishal sir, because this was the most important and typical limb of this definition of a current liability. The trade payables are always the most important part of the liability side. And Praveen sir, what do a payable, when a payable should be classified as a trade payable?
So, Jansab, trade payable is one of the term which is extensively used by all the financial statement preparers, whether corporate, non-corporate, LLPs, non-LLPs, not-for-profit. Trade payable is something which is very, very commonly used and very, very important, component of the balance sheet. So, there is a definition which has been given in the framework, and I will, encourage members to go through this guidance note. And this guidance note very clearly and very in very simple words, it gives you answers to your queries, including the trade payable. So point number 5 on notes, which are general instructions for preparation of balance sheet. It mentions that a payable shall be classified as a trade payable if it is in respect of the amount due on account of goods purchased or services received in the normal course of business. So although in our general, understanding, we understand what is trade payable. So this definition is not far or not away from what we normally understand, but it is always better to refer to the guidance note or the literature. And when you look at the framework, when you look at the guidance note, these definitions bring more clarity. So if you have some amount which is payable because of amount due on account of goods which were purchased or the services which were received during the course of your normal course of business, then these are trade payable. So many times what we see is that some of the smaller enterprises like proprietorships or partnership firms or non-corporate entities, people get confused in loan from friends and relatives as well as trade payables. So please be very careful when you're defining or classifying an amount payable as a trade payable. It has to be in normal course of the business, and this amount should be in consideration of whether the goods received, purchased, or in consideration of services which we have received. So that's a trade payable for you. And I think this is the fundamental issue when you purchase goods, and if you start showing it as loan, it becomes a challenge. And we observe when we look into some of the reports where we find that people have not clearly understood the meaning of trade payable. So this is Jensab, very, very important aspect. Yeah.
See, Praveenji, sometimes no, we usually buy capital goods in the business, and there are payables against the capital goods also. Whether these creditors against capital goods should be classified as trade payable or should be separately disclosed as creditors against capital goods.
So both the practices are prevalent, creditors against the capital goods. So I think we should go strictly by the definition which is there. A payable shall be classified as trade payable if it is in respect of the amount due on accounts of goods purchased. the word which has been used in the guidance note is goods purchased or services received. So we should be clearly defining. If it is against capital goods, then we have to separately mention it.
Sometimes we do write of the trade payables, or we do recognize the trade payables.
Yeah.
Does this framework for preparation and presentation of financial statements give any clarity on the trade payables which have been written off in the books of account?
So there are some guidance which has been given about writing off, but we need to be very careful till the time. So our framework is based on substance. It's a substance-based framework. So we need to really be very sure because writing off something is to be done only when there is a full surety that you're not going to pay it.
Thank you, sir. You have already defined the term equity. Now, see, Vishalji, what are the disclosure requirement in notes to the financial statements of these non-corporate entities and LLPs with respect to the owners funds, which we call the residual of the assets and liabilities?
Yeah, so with respect to the owners' funds, or in case of a firm or LLP, that we might say the partners' fund, the disclosure requirements are that the full movement of that should get captured. So typically the capital account that would say the capital or current account, or I would say and or current account, the full movement is required to be disclosed as per the guidance note. So where we would have the opening balance as of the first day or beginning of the year, we would have then the next disclosure requirement is with respect to the capital introduced or contributed during the year. Thereafter, remuneration for the year, interest for the year, withdrawals during the year, share of profit or loss for the period or for the year, including the percentage. So both the disclosures are required, the percentage share of profit or loss, as well as the amount, and finally the closing balance. So typically the whole movement is required to be disclosed under the owner's fund. Thank you, Rajesh.
Thank you, sir. CA Praveen Kumar ji, now the owners funds includes the reserve and surplus also. Sometimes it are included, as you said, it is profit for the year is to be added to the owners funds. Sometimes they are parked separately in a reserve and surplus account. How the reserves and surplus are classified in the notes to the financial statements of a non-corporate entity or LLP?
So you're very right, Jansab. Sometimes the reserves or the profit of the year is not added back to the capital of the partners in case of LLPs, or it does not become part of the capital. So
sorry to discuss. More importantly, when there are capital reserves and revaluation reserves.
Absolutely. So the guidance note very clearly defines how to classify reserve and surplus. So there are 4 parameters which they have given. So reserve and surplus to be classified as one is capital reserve, second is revaluation reserve, third is other reserve. So these are the 3 areas in which you have to define. And you also need to define the nature and purpose of each reserve and whatever the amount in respect thereof. And fourth one, which has been defined in the guidance note, is about undistributed surplus. So this is, whatever is balance left in the statement of profit and loss, that has to come into undistributed surplus. So these are the 4 bullet points which have been defined in the guidance note. And this is what reserves and surplus for you.
When undistributed profit is credited to the capital account, say in the first account of the capital funds or the owners fund, then there is no need to show this undistributed profit separately under the head reserves and surplus.
Yeah. So if they have not distributed it to the capital, then there's that is why there is a 4th category which is required, which is undistributed surplus.
Thank you, sir. Thanks, sir. Say Vishal, sir. sometimes there are losses and there is a debit or negative balance in the reserves and surplus. How the debit or the negative balance of the reserves and surplus, including any undistributed surplus, should be presented in the financial statements of a non-corporate entity under the LLPs.
All right. So continuing from where Praveenji left, that it's only the undistributed amount of the profits that would be there as part of the undistributed surplus under the reserves and surplus. Now, there is always a possibility that there might be losses in the non-corporate entity or the limited liability partnership, and therefore the debit balance of the statement of profit and loss, that would be shown as a negative amount under the head undistributed surplus under reserves and surplus. Again, the same principle, I'm reiterating what Parinji mentioned, that if this is not distributed to the capital accounts, then this debit balance of the statement of profit and loss, that would be shown as a negative amount under as undistributed surplus under reserves and surplus. And the balance of reserves and surplus, after adjusting the negative balance of surplus, if any, so the balance after adjustment of the negative amount shall be shown under reserves and surplus. Even if the resulting figure, that means even if the balance is negative, it would still be shown under reserves and surplus as a negative, as a minus amount. I would just like to share that initially, I remember our earlier days of the CA, where we used to show that debit balance, especially on the asset side, as the line item at the bottom. So those days are gone. And now what is required is that even if it is a negative balance in the reserves and surplus in totality, then also it would still be shown under the heading of reserves and surplus only.
Thank you, sir.
Thank you, Rajesh.
The borrowings are also the most important part of any financial statement. See, Praveenji, how the long-term borrowings are classified in the notes to the financial statements.
So actually what we are discussing, almost everything is most important.
Yes, definitely liability side is the
Absolutely.
most important side, because this is the most important for the stakeholders.
Stakeholders. And actually, when an entity goes to any lender, whether it is a banker or NBFC or any other investor, they always look at the borrowings, because if even if the audit is to be done, you first look at the borrowings of the entity. And long-term borrowings are a very significant part of the any of the balance sheet. So basically, they have to be defined separately, because the ultimate objective of these financial statement is to help user making a decision. And one of the significant user is the lender or investor or a person who is going to give money to the company or the non-corporate entity. So any user would like to know what are the borrowings, and even in the category of long-term borrowings, which kind of borrowings are these? So the guidance note gives guidance on this long-term borrowings. They have to be classified in separately for separate item. For example, the term loan, and term loan has to be defined separately from the bank and from non-bankers. Then deferred payment liabilities, they have to be separately defined. Then loans and advances from related parties, a very, very popular term, loan and advances from related parties, they have to be separately classified. And then long-term maturities of finance lease obligation also has to be separately classified. And then if any of the borrowing, which is a long term, is not falling in these categories, it's not falling in borrowing from banks, long-term borrowing from other parties, or loan and advances from friends and relatives, or maturities of finance lease obligations, then there is a separate category where you will be mentioning and specifying the nature, and you will mention it in other loans and advances. So this is how long-term borrowings have to be defined. Further, the guidance note also says that it has to be defined further into secured and non-secured. So this is how long-term borrowings need to be defined and classified in the financial statements. Jain sir.
Thank you, sir. Say Vishal Doshi ji, unsecured loans are more in non-corporate entities. In corporate entities, we do have unsecured loan, but that portion of unsecured loans in corporate entities are very, very less. Family loans and other loans are there in these non-corporate entities, which are usually unsecured. And what are the, I would like you to please explain what are the additional disclosure requirements as per this guidance note in case of secured and unsecured borrowings in the financial statements. These will cover definitely the long-term and short-term borrowings also.
Correct. So again, continuing from where Parveenji left, definitely the first would be the secured and unsecured loan would be classified as short-term or long-term. Irrespective of whether it is short-term or long-term, as far as secured borrowings are concerned, the additional disclosure requirement is the nature of security that shall be specified separately in each of the cases or each of the borrowings. So, Rajaji, like you mentioned, that in case of non-corporate entities and LLPs also, there would be bank borrowings in terms of maybe a cash credit or a working capital facility, where the security might be the trade receivables, the inventories, along with some collateral securities of the partners or the proprietor. So all these securities they are required to be mentioned. For term loan also, it might be against the asset. In addition to some and additionally some collateral also. So all these securities need to be specified. If the loans are guaranteed by partners or promoters or owners or anybody else, even that disclosure is required to be made as far as the loans are concerned. In case of unsecured loan, the fact that needs to be mentioned, whether it is short-term or long-term, that this particular loan, especially from friends or relatives or from the partners, that these loans are unsecured. One more additional reporting requirement are the terms of repayment that is required to be disclosed as far as the loans are concerned. So these are the disclosure requirements with respect to the secured and unsecured loan in case of the non-corporates and the LLPs.
Thank you, sir. Say Pramodji, Vishalji has rightly said when there are some terms of repayment obligation, that has to be separately disclosed in the financial statement. I would request you to throw some light what are the disclosure requirements in the financial statement when no terms of repayment have been defined for the long-term borrowing or a short-term borrowing.
So this is an important, this is a challenge in front of preparers of financial statements, and especially non-corporate entities, when there are many times those repayment terms have not been clearly defined. If it is payment on demand, then it has to be mentioned like that. If it is payment, repayment is on during a particular period, then it has to be defined like that. And then if there are any interest components, or even if there is interest waiver, that also has to be defined. So basically, this is a very practical aspect, especially when we are dealing with non-corporate entities. There are borrowings which might have been taken from relatives or friends. And many times, the challenge which is faced by the auditor community is, they say that we do not have a written agreement, or repayment terms have not been defined. So I would recommend, it's a personal recommendation, that please have it on paper, whatever the terms are of repayment, and then those have to be disclosed in the financial statement as well. If you do not have those written documents, at least there might be some personal agreements which might be there, and the management can give a representation that these are the terms which have been agreed. Even if it is payable on demand, that has to be mentioned in the financial statements, and these notes will be very, very important for user of financial statement to know what kind of loan liabilities, what kind of long-term or short-term liabilities we are dealing with, when they are investing in the company or when they are giving money to the company, when they are lending money to the entity, basically. Yeah.
Thank you. So because when the terms of repayment has not been defined, if we take it as that these are repayable on demand, that it always becomes a current liability.
Absolutely.
It might be the case that definitely terms are not defined, but that is a long-term liability.
Yeah. So
But
this is something which is which is a practical challenge which I mentioned. Whether the preparer of financial statements, they go through the guidance note or not, but they face this challenge, sir, that there are many times there are amounts which are lying in the financial statements for which repayment terms have not been defined, but they give a declaration that these are long term. They will not be coming up for payment in next 1 year. So we have to be dealing with this in much more careful manner, and especially when a qualified chartered accountant is auditing those financial statements.
thank you, sir. CA Vishal Doshi ji, moving on to these provisions, how are the long-term provisions classified in the notes to the financial statements?
So long-term provisions, they would be classified one as a provision for employee benefits, which would cover the provision for gratuity, which would cover the provision for leave. And second category is with respect to the provision for income tax or the others, where things like even a warranty provision can come in. So warranty is not specified, it would come in the others category in the guidance note, but these are the classifications. So one is you have employee benefits, and the second you have others where income tax is there, and maybe any other additional provision that is there would also get reflected or classified accordingly.
Thank you, sir.
Thank you.
Say Praveen ji, we have dealt with long-term borrowings. Now the short-term borrowings. How these short-term borrowings are to be classified in the notes to the financial statements?
So, Mr. Jain, this one is critical for any user, especially the regulators or the banks, which are dealing with this entity, and primarily they need to be classified as short-term borrowings, loan payable to the banks or from other parties. So that's the first category in which you'll define whether these short terms are from the bank or other parties. And worth mentioning is a lot of these entities, they enjoy cash credit limit. Please remember that these cash credit limits are generally short term because they allow this, they sanction this limit for only 1 year, and many times the limit gets renewed. At the time of renewal, it can get reduced or it can get increased, but generally they are classified as loan repayable to the bank. So short-term borrowings is in case loan payable on demand from the banks and from other parties. That's one category. Then loan and advances from related party is also one of the category which has been defined in this guidance note. Although the guidance note is applicable from 1st April 2024, but please remember, there's a technical guide which has already been issued by the institute. And right now, when we are talking, that technical guide is alive, it's applicable. So second category will be loan and advances from other parties. Third category will be other loans and advances. And you will, the preparers of financial statement need to specify the nature where other loans and advances. So this is the first, classification of short-term borrowing. Then there are three others. Second one is borrowing shall further be subclassified into secured and unsecured. Like same thing what we have done for long-term borrowings, short-term borrowings will also be classified into secured and unsecured. And also nature of security shall need to be mentioned in the notes to accounts. And it will be separately for each loan and advances. The third category is where loans have been guaranteed by the proprietors, by the partners, by the owners or others, the aggregate amount of such loans under each head needs to be disclosed. And fourth category is current maturity of long-term borrowing shall be disclosed separately, because this is a current, and the moment you say it is current, that means it will become short-term borrowing. So you have to please remember that these four categories have been defined in the guidance note. One is loan repayable on demand from bank and from others. Then in the first only, loan and advances from related parties. Third, other loans and advances specifying the nature. This is the first category. Second is subclassifying into secured and unsecured. Third is where the guarantees have been given. Separately, you will have to show that short-term borrowings and then current maturities of long-term. So this is how short-term borrowings have to be defined. And your liquidity ratio of the entity is very heavily dependent. It is very heavily dependent on short-term borrowing. So any person investing in these entities would be looking at the borrowings which are short term and long term. And also remember that large number of failures at a global level. When a banker is giving you a facility for short-term advance, whether it was used in long-term investments or not. I think of late we had seen some very large failures, and this guidance note is already addressing that issue. It is providing information to the user of financial statement. What are the short-term borrowings? What are the long-term borrowings? And then any user can very quickly make out whether these borrowings were used for the purpose for which they have been given to this entity or not. So this has to be kept in mind, that this is very, very relevant and very important classification. So every user of financial statement will look at short-term borrowings and long-term borrowings with a very, very very strong curiosity whether these were properly used by the entity or not.
Thank you, sir. The participants have already heard the views of CA Praveen Kumarji on long-term borrowings. Now I request CA Vishal Doshi ji to throw light on how the loans from relatives are to be classified, whether as long-term or the long-term, short-term.
Yeah, this is a very tricky question, and I would say, that this is an area which is pretty, from an auditor's perspective, gray area, because there would not be much of a documentation or a written understanding with the between the borrower and the lender. And many times, when we have a lighter movement during the course of audit, we say, whether these loans are typically payable when able types. That when the entity is able to pay back, they would pay back. Otherwise, till that point in time, this loan remains as a loan, and therefore to classify as a short term or long term, it becomes pretty challenging. So first thing is, I would always suggest that there should be some agreement or terms or a document or a letter specifying some very basic facts, not just from an auditor's perspective, but even from a commercial understanding perspective, with respect to the rate of interest, the periodicity of interest. If the interest is not payable regularly, whether it is cumulative, non-cumulative, any time frame for principal repayment, whether it would be a bullet repayment or it would be again over a period of time. These are some 4 or 5, whether it is secured or typically from relatives, it would always be an unsecured loan. That is what we have seen so far. But all these, some basic 4 or 5 conditions that should be documented, and I believe even an email exchange or an email confirmation should suffice from a documentation point of view between the lender and the borrower. And otherwise, at the year end, at least there should be a confirmation that should be taken from the, I would say, lender, by the borrower, because here we are talking from the borrower's perspective as a non-corporate entity or a limited liability partnership. So at least at the year end, there should be a confirmation that should be obtained about what would be the plan or the outflow in the next 12 months, or I would say 12 months from the reporting date, whether there is any principal repayment that the entity is required to do. Because if you remember earlier, I answered the current and the definition or the classification of a current liability, where one of the criteria was that if that amount is to be settled or paid within 12 months from the reporting date. So if that amount, that loan amount, whatever is outstanding as at the balance sheet date, if there is a confirmation available from the lender that the lender is not going to demand any amount in the next 12 months, then it can be classified as a long term for that year end. And if there is a, I would say, a staggered payment, or there is some payment of principal that would happen within 12 months, and that amount should be classified as short term, whatever would be payable in the next 12 months, within the next 12 months, and anything beyond that would become long term. This is how I believe, especially from a related party, the classification between short term and long term. And I would say the classification would depend on the documentation, and therefore, as auditors, the documentation is very important to support whether it is a long term or a short term, because like very rightly Parveenji mentioned, that this would have an impact on the ratios and the borrowing. Is there any external borrowings, the liquidity and all those things? And therefore, as auditors, it's very important to have some backup documentation of classification between short term and long term, especially from the related. Thank you, Rajesh.
Sir, further, the current maturities of long-term borrowings are to be disclosed as short-term borrowings, as we do in the corporate entities also.
Yes,
From
yes.
last
Because
3 years,
again,
it has
like I
been
said,
changed from last 3 years,
exactly,
it has been
Rajesh.
changed from other liabilities to short-term borrowings. So in these cases, when there are no agreement between the relatives, sometimes it is being given by the close relative family members of the partners or the proprietor only. Then how to classify this current maturity of long-term borrowing in the current this short-term borrowings?
Yeah, so see, like I mentioned, that so one thing is, like you rightly said, that current maturities of long-term borrowings, it shall be disclosed separately under the heading of the short-term borrowing, because it meets the I would say criteria, one of the criteria of the current liability. And therefore, since that liability is in the nature of borrowings, it would be classified as a short-term borrowing, the current maturities of long-term borrowing. And so, like I was mentioning earlier, with in response to the earlier question that you asked, Rajeshji, that with respect to where I said that if there is a plan, already defined agreement or understanding with respect to the repayments that would be done. Let us say a loan has been taken from a relative or a related party, where there is a the installments are fixed that every 3 months, every quarter, there would be some repayment of principal that would be happening. So whatever is overdue, if there is nothing that has been paid, let us hypothetically, I'm saying for 31st March 24, if there were 2 installments which were already due as at 31st March 24, which have not been paid, and there are 4 installments due for FY 24-25, and then there are remaining installments. So whatever are the remaining installments beyond March 25, that would be classified as a long term. And whatever are those which are overdue or not paid, which were due till 31st March 24, and due in the next 12 months, the 4 installments of 24-25, total of these 6 installments would be classified as a short term. So this is how the classification would go. And like I mentioned, a year-end confirmation is very important in such cases for the purpose of classification.
Thank you, sir. This long-term and short-term borrowing, especially from the relatives, is going to give a very big challenge to the auditors. Now, since this dues to MSMEs have already been included in 43B section of the Income Tax Act from Assessment Year 24-25, say Praveen, what are the details required if the trade paper include the details of MSMEs? This becomes most important because of section 43B also.
Yes, very relevant and also quite significant, because this is where all the auditors will face a challenge. As a business entity, they may be they may be uh, taking material or recognizing trade payable. They might not be collecting information whether the people with whom they are dealing with, they are registered under MSME, and whether they are MSME or not. So even the preparer might not have a insight or the visibility of whether they are dealing with MSME or not. And then the auditor comes into picture, and the auditors will need to report, as you had mentioned. So now this guidance note, it provides very clear guidance to the preparer of financial statements, that what kind of information is required to be given as far as it relates to MSME. So there is a very detailed guidance in in the general guidance, which is in F for further paragraph. So this is trade payables. So the following details related to micro, small, and medium enterprises shall be disclosed in the notes to accounts. Number one, the principal amount and the interest due thereon. So this is to be shown separately. How much was the principal and how much was the interest remaining unpaid to any supplier at the end of each accounting year. So this is number one. Each supplier, you will have to separately give how much is the principal and how much is the interest which is payable. Second is the amount of interest paid by the buyer in terms of section 16 of MSME Development Act 2006, along with the amount of payment to made during each accounting year. So this is the second requirement. The third requirement is, so first one is principal amount and the interest due at the year end, at the at the end of each accounting year. Second is the amount of interest paid by the buyer in terms of section 16. Third is amount of interest due and payable for the period of delay in making payments which have been paid but beyond the appointed day during the year. So wherever the delay has happened, that has to be reported in the notes to accounts, but without adding the interest specified under MSME Act. And the fourth is in amount of interest accrued and remaining unpaid at the end of each accounting year. So, and besides all of these, the amount of further interest remaining due and payable, even in the succeeding years, until such date when the interest dues above have actually been paid to disallowance of deductible expenditure under section 23 of MSME Act. So, there are, there's an explanation which is given in this guidance note. It says that term appointed day, buyer, enterprise, micro enterprise, small, and supplier shall have the meaning as assigned to in MSME Act section 2. In B, D, E, H, M, N, various sections are there in section 2 of MSME Development Act 2006. So please note that this will be a very significant ask from these preparer of financial statements, and this information has to be very carefully calculated. Information has to be disclosed, and it has to be disclosed very meticulously in these financial statements. And guidance note is giving you very clear guidance what all to be mentioned, how it has to be shown, and it has to be shown like this only in the financial statements. This is a new requirement. It's a very, very urgent requirement. So I would recommend that the members should get familiar with these requirement, before the year starts.
Thank you, sir. Because from this year, this financial year, this is going to affect your taxable income also.
Of course. Because this very clearly gives, also the guidance note tells you that why this information is required. It is because of disallowance, calculating the disallowance also.
Yeah. Now moving on to other current liabilities. See Vishal Doshi ji, please, how the other current liabilities are classified in the notes to the financial statements?
So, as per the guidance note, the other current liabilities, they shall be classified as A, current maturities of finance lease obligations. I would just like to share here that as far as the lease accounting is concerned, there is a difference between AS and Ind AS, because many times members mention that they don't find this in the published accounts of listed companies. So here I would like to share that the standard on lease is different as far as listed companies is concerned and as far as the non-corporates and LLPs is concerned. And therefore, this line item appears there as current maturities of finance lease obligations. So that is the first classification under other current liabilities. The second classification is interest accrued but not due on borrowings. So here also I would just like to give an example that many times, especially when we talk of the EMIs that companies or the entities take, where the due date is, let us say, every 15th of every month. So from 15th March to 15th April would be one of the installments. In this case, from 15th March to 31st March, following accrual basis of accounting, the interest has to be provided for. And since this is not due, because the payment becomes due on 15th April, as at 31st March, this would be classified as interest accrued but not due on the borrowings. So this is the second classification that is there under other current liabilities. The third one, a relatively simpler one, is interest accrued and due on borrowings. So in most of the banks loan we have seen, with respect to the term loans and the cash credit working capital facilities, where every month end there is an interest or a quarter end interest entries that are passed in the borrower accounts. So this is where it would come as interest accrued and due on the borrowings. The next classification is with respect to interest income received in advance and unearned revenue. GST payable, TDS payable. So these are the other classifications, and definitely finally the last one being other payables, and there we are to specify nature. So there are 8 classifications which have been given in the guidance note. So you have current maturities of finance lease obligation, interest accrued but not due, interest accrued and due, income received in advance, unearned revenue, GST payable, TDS payable, and the residual category, which is others, which has to be specified. Thank you, Rajesh.
Thank you, sir. CA Praveen ji, now we move into the employee liabilities. Sir, how are the employee-related liabilities such as pension obligations recognized and measured in the financial statements of a non-corporate entity?
So I think, Jain Saab, if this one question, employee benefits, whether it is pension, whether it is gratuity, I know your question bank has got a lot of questions around this, and I think there must be one separate session of 2 hours only on the employee benefit, because this is one issue which is being discussed, asked, answered, and a lot of debate happens in the accounting standard board, in AASB. Whenever we deal with the small and medium practitioners, most of the time they ask this question: how to, whether gratuity, whether you need to have actuarial, whether you need to have pension related provisions. I think this is one of the very critical area, employee benefit. And there have been case studies where people have used this, the subjectivity of accounting standard 15 in various forms. And this is one area of challenge, because when you read a financial statement, the maximum non-compliance happen in this area. Maximum non-compliance. So before getting into answering 2 or 3 questions together, I would recommend that you should go through. There was an announcement in the institute which I had mentioned, and later on it became a technical guide, and now the guidance note. It very clearly defines level 1, 2, 3, and 4 enterprises, based on the turnover, based on the number of employees, based on the borrowings. There are different conditions for which you will have level 1, 2, 3, and 4. And as far as employee benefit is concerned, very detailed guidance is given on page number 42 and 43 of the guidance note. Out of all the standards, this particular standard on employee benefit, there has been a very detailed guidance in the guidance note. So I'll read some portions from there, some extract that level 2 and level 3 non-company entities whose average number of people employed during the year is 50 or more, they are exempted from applicability of some of the paragraphs. Some of the paragraphs they are exempted. So AS 15. So first thing is very clear. Whether it is a small enterprise, micro level, level 1, level 2, level 3, level 4, accounting standard 15 is applicable on all of them. There are certain exemptions which are given to level 2 and level 3. There are certain exemptions which are given to level 4, which is micro, small, and those enterprise. So how do we define? So one way is like, if I read from subclause 4.1, level 2 and level 3 non-company entities whose average number of people during the year is 50 or more are exempted from applicability of some of the paragraphs, like paragraph 11 to 16, then 46 to 46 and 139, recognition of 50 and 116. So when you get into the jargon of the language of the guidance note, but most important part is number one, if there are 50 or more employees and you're level 2 or level 3, then you have to get the actuarial done. You may not make the disclosure in detail, but you will have to have the actuarial done, and you will also need to make a present, in the presentation, you will have to mention the assumptions of actuarial. So this is something which is very, very basic information which you need to give in your notes to accounts. So you will say that, okay, level 2 and level 3, if we are, and if number of people are less than 50, then what? You will still need to get the actuarial done, but you need not disclose the details. So this is something which is very important, that you're discounting. You can apply the methods because there is, in the framework, there's a concept of materiality also. You will have to apply, you have to make provision for the gratuity that is given in all the entities, level 1, 2, 3, 4. In level 2 and 3, if the employees are 50 or more, you will have to make, actuarial provision, and then you will need to disclose the assumptions. And level 2 and 3 will go, if there are less than 50 people, you will need to make a provision, but you will need to be careful what kind of assumption you have used. You have used the actual method, you have to mention it in the notes to accounts. So this is something which will go not only for gratuity, but also for pension. But I will not go further into much detail because I think then we will start discussing only AS 15 and other questions might get remains. But one thing which I want to very, very loud and clear mention here, that AS 15 employee benefit is applicable on all the organization level 1, 2, 3, 4. There are some exemptions. You will need to open up the standard and see what exemptions are there. Some exemptions are related to, making a disclosure of assumptions. Some exemptions are related to, actuarial also, but you will have to make a provision as per AS 15.
If it is mandatory to make a provision of gratuity in the case of proprietorship, partnership, and LLPs, if it is not so made, then we have to qualify the audits.
Without doubt, because you say in your audit report that the financial statements are complying with accounting standards. So if accounting standard number 15 has not been complied with, you'll have to mention in the report that they are complying with the accounting standards except AS 15.
Thank you, sir. Thanks a lot, Ji. C. Vishal Doshi ji.
Vishalji, please add this because
Yes.
I will take liberty to ask a supplementary question to Parveen ji, because this is again for the benefit of the audience. Parveen ji, many times, and I would say not only for the non-corporate entities and LLPs, even for private companies and all, the argument, or I would say the argument from the entity comes that, especially for gratuity, sir, that the employee को भी 5 साल नहीं हुए हैं. So maybe, sir, you can just throw some light for the benefit of our members that what is to be done in that case. So I just wanted to barge in and ask this for the benefit of our fraternities. Thank you.
So whenever I am, sharing dais, I always expect out of the syllabus questions. Especially when we are dealing with the Vishal Bhai. So I think we need to understand the concept of gratuity. So if an employee has completed 5 years, then they will become, the entity will become liable to pay them the gratuity. So when they have not yet completed 5 years, but it does not mean that in future that liability might not arise. They may complete 5 years. So this is where the management estimates will come into picture. They will look into the trend of the organization and they will look into other variables. But employees who are working, let us say even in first year or second year or third year, it is presumed that some of the employees will complete 5 years. And after 5 years, if they leave, there will be some gratuity which will be paid to them, which belongs to this particular year. So that is why it is very important for making that provision, which is going to be paid if that employee completes 5 years or 10 years, some portion will come into play. And because it is a complex kind of calculation, there are a lot of estimation, there are a lot of probabilities. That is why we take the help of, the companies or entities, they take help of actuaries to understand what can be the amount which will be applicable or which will relate to this particular year for all those employees who might complete 5 years or might not complete 5 years. So I hope that addresses.
Yes, absolutely.
But it is very important to make a provision, and that's where the management estimates and judgments will come into play.
Thank you, sir. Also dealing with, apart from this financial statement, dealing with AS15, where
Yes.
there is most non-compliance in case of non-corporate entities.
Absolutely, sir. Absolutely. This has been again and again emphasized by the Accounting Standard Board, even Vishal Bhai and Pramod ji and Abhay ji, whenever they go and speak in any conference, in any of the platform, they say that the auditors community need to be very careful when they are dealing with AS15. Please remember the guidance note very clearly says it is applicable. There are some exemptions, but those exemptions are related to what kind of provision you should be making, what kind of disclosure you should be making. But the undercurrent, but the base is like you will need to apply and comply with the requirement of AS15. Yes.
Thank you, C. Praveen ji. Now, Vishal Doshi ji, sir, other current liabilities are classified into 8 categories. 2 of which are income received in advance, and the second one is unearned revenue. Can you please explain some example of these 2 terms, income received in advance and the unearned revenue?
Sure. Right. So I would say a very apt question on this. So typically income received in advance, I'll just try to explain that what it would actually mean is that the invoice has already been raised and payment has also been received from the customer, but that related goods or services are yet to be delivered or provided. So I would say the whole principle is based on the matching concept over here. What we say that whenever I recognize any income, the corresponding expense has to be in the same period, and vice versa. Whenever there is an expense that has been incurred, the corresponding income has to be recognized in the same period. So that is why this income, because the related costs are not yet been incurred. So again, taking that example, let us say, and why this would arise is maybe because of the contractual terms. Typically, I would say because of the contractual terms. Many times, when in case of construction contracts where we follow the percentage of completion method for the accounting purposes, but whereas the payments are based on milestones. When you have completed certain work and the payment becomes due, but corresponding income might not be eligible for recognition as an income in the books of account. So this, I would say, typically in these cases, because their invoice would be raised on the milestones, the payment would be received, but the corresponding income would not be recognized in the books of account. This would generate an income received in advance. Other examples also I can share of this unearned revenue or the income received in advance, like rentals, where rent is received in advance. So let us say your client is the landlord, is owning properties, and they have leased out properties to I would say the occupiers, and they have received rent which is in advance, which is not pertaining to this financial year. Therefore, that would also be income received in advance. Other examples also may not be related to non-corporates, but just to throw light about what can possibly be income received in advance, like we have a prepaid insurance. And here I'm talking from the side of the insurance company, not of the person who is taking insurance, because for them it is an expenditure. We are talking about income received in advance. So from an insurance perspective, you have prepaid insurance. Maybe for airlines companies where the tickets are booked in advance for travel that would be undertaken after 31st of March or on or after 1st of April. Tickets are booked, income is received. So this would be income received in advance. Many times, even for the newspaper or magazine subscriptions which are there, where it is over a period of time. Many times magazines we subscribe for a period of 3 years or a period of 5 years. And this money is, on a time proportion basis to be recognized because the corresponding costs relating to that would be in the respective years. Therefore, the revenue also should be typically in the respective years. So this would be some of the examples where that income received in advance or that unearned revenue would be recognized under the other current liabilities. Thank you, Rajesh. Parinji, would you like to add anything to any other examples which I might have missed out for the benefit of our audience?
No, I think I'll move to the next question which Rajesh ji was asking.
How
Rajesh,
the short-term provisions are classified in the notes to the financial statements?
the short-term provision you are asking?
Yes, sir.
Yeah, so maybe the amount shall be classified. So primarily two classifications, two subcategories. One is provision for employee benefit, because that is something which is very major chunk, and then the others. So these are the two areas in which you will identify your short-term provisions.
Okay, sir. See, Vishal sir, how and where to disclose this provision regarding sales return as per the accounting standard 29?
So, Rajesh, with your permission, I would take this question and the next question along with this, because when we talk of provision, there is a difference between provision and an expense payable or a liability. So I would like to connect the two because they are related. So I believe, and this is again, I think Parinji and Rajeshji, you would agree that after the AS 15, the next most pain point would be classification between provision and liability. So
Yes,
AS 15 definitely would top the chart, but after that it would be classification between provision and a liability. And friends, it's very important to understand the difference between the two. It's very categorically mentioned as under AS 29 also. So if we look at the definition, a provision is a liability which can be measured only by using a substantial degree of estimation. I am stressing on these words because that is what is the main distinction between a provision and a liability. So provision is a liability but which can be measured only by using a substantial degree of estimation, whereas a liability is a present obligation arising from past events, the settlement of which is expected to result in an outflow of resources embodying economic benefits. So this is what is the distinction between the provision and the liability. So in case of a provision, like we discussed earlier when we talk of provision, especially under AS 15, provision for gratuity, provision for leave encashment, there is a lot of estimation that is involved in a provision, because there are actual assumptions with respect to the salary increases, the expected rate of returns, the the way in which employees would leave the organization. So there are a lot of these assumptions and estimations based on which finally a amount is derived, and therefore it comes as a provision. But when we talk of sales return, I would just like to say two parts. It can be a provision, it can be a liability, depending on what exactly the sales return is. So many times there are these schemes that the shop owners they come out with, where they mention that you can return any goods in the next 60 days or in the next 90 days. These are a lot of these schemes, marketing schemes, nowadays we see are being floated. So what happens as of 31st of March? So for whatever is the period that is remaining with respect to the sales return, where there is a possibility or a probability that the return might come based on the past trends. If this is the amount that is required, then it would come as a provision. But I would look at the another case scenario where the sales has happened, the return is already has been initiated. Let us say it is something with respect to an engineering company, a machinery, where it takes time for the goods, the sales return to come back to the premises. In this case, there is no estimation as such, because it has already been communicated that the customer is going to return these goods to the supplier or to our client. In this case, this is definitely a crystallized liability, and it would therefore come under other current liability, or maybe I would say it would be reduced from the sales itself. So in this case, therefore, it depends on what is the way of calculating the sales return, whether it is based on an estimation or it is based on an actual transaction. So the disclosure would happen accordingly. Another distinction or difference I would say is with respect to the disclosures between provisions and liabilities. So if we look at the para 66 of AS 29, it talks about the disclosure, where the carrying amount at the beginning of the period, additional provisions that are made during the period, the amount used from those provisions during the period has to be mentioned, and the unused amounts reversed is given, and then you have the balance at the end of the year. So this whole movement of the provisions is something which has to be disclosed when you are showing anything as a provision. So I would just like to extend that many times we see things like a provision for audit fees. Just because the word provision is used in the ledger, it would not qualify for provision as defined under AS 29. And therefore, we have to look into what is there. Wherever there is a substantial degree of estimation, to quantify that amount, that is where the provision would come. And once the provision comes, the movement of that provision as required under the disclosure requirements of AS 29, it has to be done. So typically, bonus payable, electricity expenses payable, telephone expenses payable, these are all liabilities and not provisions. Thank you, Rajesh.
Thank you, sir. Say, Praveen, would you like to add something to this difference between expenses payable and the provisions?
I think Vishal Bhai has very clearly and very, very carefully explained it very nicely. So I think people will go back to the recording of this webinar and see what is the difference between provision and
Provision
liability.
and expenses.
I think very nicely explained by Vishal Bhai.
Thank you, sir. Thank you, sir. Now, moving on to the contingent liability part of this financial statement. When the liability is considered as a contingent liability, and how these contingent liabilities are disclosed or presented in the financial statements.
Yeah, again, one of the subjective issue and one of the area where not only the preparer of financial statement, but the auditors also face challenge. And also in case of bank branch audits, this is one area where almost every small and medium practitioner, they face this challenge, whether this liability is a contingent liability or whether it is not. So anything which has not become a liability, but there is a probability of becoming that as a liability, there is a contingency involved. So that's a contingent liability. And also the definition which has been given, or also the classification, the guidance is given is the contingent liability shall be classified as claim against the non-corporate entity which has not been acknowledged as debt. Then the guarantees and other monies for which non-corporate entity is contingently liable. So three categories you have to define, and you have to make a disclosure of all the three kind of contingent liabilities. But please remember that whenever any contingent liability arises, so there can be, so don't get confused with actual liability. Don't try to put that as contingent liability. One is actual liability where the liability is done, then the provisioning is to be done, then the provision is made, then that's not a liability but a provision is made, and then the contingent liability which has only to be disclosed because of the uncertainty. And then there are some liabilities which is practically speaking the auditors inform to those charged with governance that there may be a possibility of this particular amount coming as a contingent liability to the company. So basically the categories to be classified are three categories: claims against the entity which are not acknowledged as debt. So there is a claim which has not been acknowledged as debt. So that's one category. Second category is where the guarantees have been given. So that is again a second category. Third is the money for which non-corporate entity is contingently liable. There is a but there is a liability. So these are the three categories in which you will need to make a disclosure for. So be careful. Liability, taking it as a debt. Then a liability where you have not taken it as a debt, but there is a claim. And then you have given a guarantee. And then there are possibilities of getting that created as a liability. So this contingent liability is also one area where the auditors face a lot of challenge, how the provisioning is to be done, how the disclosure has to be made. Many times they don't accept that debt as a liability, but there is a claim. So one need to be very careful whether the preparer of financial statement or whether the auditors who are giving opinion on these financial statements. So there need to be extremely careful and also need to go to the substance whether these contingencies are significant enough to impact the going concern also. It's not only contingent liability, but other areas also get connected. Many times, merely because you have not taken that claim as debt, it does not mean that, the management estimate is right or not. You as auditor will need to go into the detailing to understand why it was not taken as a debt and why it was taken as a contingent liability. So the concept of professional skepticism will also come into play, where the management is treating something as contingent. So you, as auditor, one need to be extremely careful in dealing with these situations.
Thank you, sir. See, Vishal Doshi ji, to get it further, in case of disputed demands, what are the criteria which should be considered to determine if that disputed demand should be presented as provision or as a contingent liability?
Right. So I think Parveen has explained the fine difference, but I would just extend a bit further. That typically, in auditor's terminology, we say probable, possible, remote. This is how we normally compartmentalize the transactions or the liabilities. So when we say probable, that is where the provision is required. And because if you look at the standard, what it says is that if there is a present obligation that probably requires an outflow of resources and a reliable estimate can be made of the amount of obligation, then it has to be provided for, then it is a provision. So there is a probability of outflow of resources and there is a present obligation and therefore this provision is required. The next category is what we talk about possible. So if there is a possible obligation or a present obligation that may but probably will not require outflow of resources, then it is a contingent liability. So you have the possibility of there, but most likely than not, it would not be probable that there would be any outflow of resources, and therefore it is a contingent liability. And the third category, which we say is remote. So there is a possible or a present obligation where the likelihood of an outflow of resources is remote. Then it is neither a provision nor a contingent liability. So for each such transaction, you can have these three buckets, whether it comes into probable, whether it comes into possible, or whether it is remote. And accordingly, the classification between provisions, contingent liabilities, and the third, like I said, remote, that no provision or no contingent liability. And this has to be adequately documented for each and every transaction that we are classifying in these buckets to justify how it fits under the respective definitions or the criteria. Thank you, Rajesh.
Thank you, sir. On this subject or topic, there is a question on the live chat. What about contingent liability or the liability under litigation?
In liability, I believe that they are not different. Liability under litigation can be a contingent liability or it can be a provision also, depending on what the expected outcome of that litigation would be. Right? So many times, and I'll give a very simple example, that many companies, they follow this method when it comes to the income tax liabilities. That when it is at the assessing officer level, if there is any demand, then many companies show it as a contingent liability, depending on the disallowances and the additions that have been made. If they are able to legally fight it out, then they show it as a contingent liability. Next, at the commissioner level, commissioner appeals level, if again that demand or that order is against the company, then the company, many times we have said, takes the view that from contingent liability, it should now be made as a provision, or maybe at the tribunal level. So depending on the litigation about what stage it is, what are the possibility of the outflow of resources happening, like I said, the probable, possible, and remote, the classification would depend accordingly. Parvinji, would you like to add anything, sir?
No, I think it is perfectly fine. Yeah.
Thank you. Thank you, sir. Parveenji, then now move over to the deferred tax assets and liability side. How and when the deferred tax assets and liabilities can be set off in the presentation of the financial statements, or they should be disclosed separately, that the deferred tax asset should be disclosed on the asset side or the liability should be disclosed on the liabilities.
So I think this is for this I will read out some literature from the income tax. There's a clarification. It talks about deferred tax assets and then deferred tax liabilities. So I'll read from there that deferred tax asset is an item of the balance sheet that ultimately either reduces the income tax liability or results in a refund of an already paid amount of income tax. It arises when there are differences in tax and accounting rules and or there is a carryover of depreciation or tax losses. So the basically when you have difference between taxable income and accounting income, that will result into permanent differences and timing differences. And that's where deferred tax assets and liabilities can be there. So there's offsetting which is allowed under the income tax. So an entity may offset the amount of deferred tax asset with a deferred tax liability if A, the entity has legally enforceable right to set off current tax assets against the current tax liabilities, and B, intends to settle the assets and liability on a net basis and see the deferred tax assets and liability relates to tax on income levied by the same governing taxation laws, which is Income Tax Act 1961. So these are the areas where you will be able to net off the deferred tax assets and liabilities.
So that means in case of non-corporate entities, this will be the most of the cases, these deferred tax assets and liabilities are to be set off because they are mostly governed by the same taxation laws, that is Income Tax Act, in most of the cases.
This is one of the conditions. There are two other conditions. You have to meet with all the three conditions.
Yes, yes.
Yeah, then only. Otherwise, asset remain your assets, liabilities remain your liabilities. Maybe Vishal Bhai would like to add to this.
Sir, I would just like to add not on the deferred tax asset liability, but on the current tax asset liability, especially the offsetting principle. Again, where I believe that we can use this forum to ensure the compliance. And like Parinji mentioned, that the offsetting principles say that under the law, if as an SSC, you are allowed to set off the asset and liability, then only it is permissible. So whereas what I'm sharing is that what happens is that we have the provision for tax ledgers, we have the advanced tax PDS ledgers, and in many what entities do is that total of provision for tax for let us say last 7-8 years, that is there. The total of advanced tax PDS, self-assessment tax, TCS also, that would be there over the last 6-7 years. Balance, knock off. If it is a liability, it goes on the provision side. If it is an asset, it goes on the asset side if net taxes is more than the provision. Technically, this is not the in requirement of the standard because the offsetting principle as an SSC, the client is not allowed to set off the demand of 1 year against the liability of another year. So technically, what is the right way is that for each year, you have to map the asset. That is the, when I say asset, it would mean your TDS, TCS, self-assessment tax, advanced tax, and everything. The provision for tax of that year and knock them off on a year-on-year basis. If for that year the provision is more, it will go under provision. And if the asset or tax is more, it will go under tax. Then you go to the next year, map the provision vis-a-vis the taxes. If the provision is more, it will go under provision. And if it is the tax is more, it would go under the asset. So this year-wise offsetting is what is required to be done. Therefore, it is highly possible that in one entity, you might have some amount as a provision for tax, and also in the same entity for the same year end, you would also have something as a refund receivable from the tax department, because on a year-on-year offsetting, this might result in. So I just wanted to highlight this in continuation what Parinji mentioned. He mentioned on deferred tax asset liability. I mentioned on the current tax asset.
Thank you, sir, for adding this on the current tax assets and the current tax liabilities. Now, sir, there are certain transactions with the related parties in most of the balance sheets. How are the liabilities and assets related to the related parties treated in the financial statements? And are there any specific disclosure requirements in case of transactions with related parties?
Yeah, so I think with respect to the loans, liabilities, the borrowings, we have discussed earlier about the related parties. So I would just like to mention that under AS 18, the accounting standard 18, it is applicable to level 1 and level 2 entities. And in this case, there are additional disclosures under AS 18 which are there, and this is so though we are on the liabilities side, I would say with respect to all transactions with related parties, there is this disclosure requirement with respect to the transactions that have been entered into during the year with the entity, and also the balance outstanding as at the year end for the entity. So these are the additional disclosure requirements under AS 18 with the related party transactions. Thank you, Rajesh.
Thank you, sir. Sir, further going to this, what are the main differences in these formats of the financial statements of a non-corporate entity and the LLP? Because both the separate guidance notes are there on the non-corporate entity and the LLPs.
So I would just like to share that there are no changes as far as the formats of the financial statements of the non-corporate entities and LLPs are concerned, except you have the owners fund in the non-corporate entities, because it would deal with entities like proprietorships and AOPs and other entities also. But when it comes to the LLPs, the headings or what is used is the partners fund, because they would always be partnerships. So other than this, there are no changes. And why two different guidance notes is because the LLP is a corporate form of entity under the LLP Act, whereas in case of non-corporate entities, there can be a variety of entities, like we have partnerships, we have the proprietorships, maybe we would have individuals, HUFs, a lot of these types of business entities that would be there, and therefore two separate formats have been given. I would just like to add one more thing over here, that with respect to the previous year amounts, because I would share, Rajeshji and Parvinji, that even when we had come out with the technical guide, members were asking that, by virtue of this technical guide, has the previous year amounts been made mandatory? So I would just like to share over here, friends, that it was always there in the framework of the presentation of financial statements to give the previous year the comparative amounts, and we have just followed what is there in the framework in this technical guide and guidance note. And therefore, my request to all our friends who are listening to us as part of this webinar, that please ensure that previous year numbers are there. And I would just like to take a couple of minutes more, Rajeshji and Parvinji, with your permission, that like it was mentioned that this guidance note is applicable from 1/4/24 onwards. But early adoption is possible, friends. And I would say that thanks to the ASB, that they have also uploaded the Excel format of these guidance notes, so that the application by our practice units becomes much more easier. And what I share with all my friends wherever I go, I'll share over here also on this platform, that like I said, early adoption is most welcome. You can download these Excel files, and what you can do is that you can, because March 23 numbers are already audited, you can ask your clients that the previous year column in these formats, they can start plotting the March 23 numbers, giving all the formula and everything. And this would give highlight some of the additional information and disclosure requirements that are there under this guidance note, which might not have been in case of a few clients of yours that was being followed earlier. So it can be written down right now, so that when your team goes for the March 24 audits, the compliance of March 24 or the number for March 24 as well as March 23 can be collected in the same go, and this will bring in a lot of audit efficiency and would reduce last minute rushing, because we all know the pressures at which we work, especially in September end, when we talk of the non-corporate entities and LLPs. And this is the time frame. So either the client can be educated and said that these are the additional information, just as Parvinji ne bola with respect to MSME. If those disclosures were not made for March 23, but in comparatives we will have to give for March 24 or maybe March 25 going forward. So that data mining can be started from right now, rather than wait till August or September and have the last minute rush. And this implementation at an early date would ease a lot of, I would say, inconvenience or pressures from the clients as well as our members. So this was just one additional thing that I wanted to share with respect to this format. Thank you, Rajesh.
Thank you, sir. So whether this new format on this non-corporate entities is applicable to all, whether they are subjected to audit or not, or it is applicable only to those entities which are subjected to audit?
So, since it is in the form of the guidance note applies to the members of the Institute of Chartered Accountants of India. And therefore, I would say that wherever these members are giving an audit report, giving an opinion on the financial statements, this guidance note would be applicable to them.
And I think, Vishal bhai, to bring the consistency in reporting all across, it is recommended that the same format can be used for non-auditing also.
Absolutely, absolutely, sir.
And here I want to just come in,
Yes, sir.
Vishal bhai and Praveen
Yes,
bhai.
Chairman, sir.
The only thing here is that the whole professional as well as the country should understand that if really India wants to achieve uh, the number 3 position in the world, want to achieve the 5 trillion economy, the financial statements are very, very important and we all will have to contribute. So when we are contributing, we should ensure that there is a standardization, as Praveen bhai very rightly said, Vishal bhai, you said, that if the financial statements are standardized, at least they would be ready to go to the next level.
Yeah,
The small businessmen. So they would be ready, they understand. So what is the importance of accounting? What is the importance of financial statements?
yes, sir.
Hence, it is recommended that everyone should follow these formats.
Absolutely.
Because sometimes non-audited financial statements, they are required to get these compliance report from the bankers. They say that you get it compliance report from an auditor, then it becomes very difficult if it is not according to the new format.
And
Yeah.
our belief. Yes, Pramod bhai.
Vishal bhai, please continue. Vishal bhai, continue, please.
What Pramod bhai, Abhay bhai, myself, Parveen, we have all been discussing is that, once this format gets rolling out, I think the bankers also, and whosoever, wherever these financials would be given, would always insist on financial statements which are following this format, so that all the information, the disclosure, presentation, like Parveenji rightly mentioned, consistency and availability of the information becomes handy to the bankers or whosoever are the users of the financial statements.
So there is one question regarding this contingent liability in the chat box. A company has given security in the shape of bank guarantee to its customers, but it is hopeful that it will not become a liability. Whether the same should be classified as a contingent liability in the financial statements?
Absolutely, it has to be, because the guidance note is very clear about it. It is the second category in which you have to mention how many guarantees have been given. So there's no doubt about it.
Because in fact, bank give a guarantee to the customer and we give a counter guarantee to the banks in that case.
Right.
Thank you, sir. Then it is up to you whether you want to now go and briefly explain again the AS15 where there is a most non-compliance in case of employee benefits. I would like you to conclude once again.
So I was anticipating this. So level 1, level 2, level 3, and level 4, these entities, uh, they have to apply these accounting standards, and there are different parameters. These parameters have been defined. So if I start reading, it will be like a lot of time it will take, and I would not like to stay between you and your dinner. So I think the most important part, so I'll just give you an example. So level 1 is listed companies, the banks, and the turnover above 250 crores, and where the borrowings is more than 50 crore, and then holding and subsidiary of these entities, level 1. Level 2, the turnover, so it's unlisted, turnover exceeds 50 crore, and the borrowings in excess of 10 crore, and holding in subsidiary of the above. And then level 3 entities whose turnover is more than 10, less than 50 crores, and the borrowings is in excess of 2 crore and holding in subsidiary. And level 4 is below all of these. Trust me, when we were in the study group and we were discussing this, I don't know how many sessions we had to spend and how many external consultancy we had to take, how many council members we have to discuss with. This was really a tough task to come down to, level 1, 2, 3, 4, and full credit to Pramod ji, who had made it possible for us to have these, this guidance in this guidance in the guidance note. So please look into these categories, and like Vishal Bhai said that the previous times have changed. Now there are different. So when you qualified chartered accountancy, then probably the conditions were different and those levels were different. But now it's very, very clearly, defining which are the levels, and then what are the exemptions which are available in AS 15 for level 2 and 3, and what are the exemptions for level 4. So that is something which is very, very important for all of you.
But earlier it used to be 3 levels, level 1, 2, 3. Now it is 4 levels.
Yeah.
Thank you, sir. Thanks a lot.
But here, Rajesh ji, just one point to add. It is not about level 1, 2, 3, 4 regarding my provision for employee benefits long term. One has to be very clear that when an entity is following a proprietorship, partnership, LLP or company, anyone, if they are following an accrual system of accounting, at least the provision for gratuity, which is a long-term employee benefit, is mandatory. Then comes the question of actuarial and the disclosures. We have seen in certain cases that the provision of gratuity is missing at various places, thinking that income tax where it is allowed on the payment basis, then we will account, or they give that as an accounting policy. Merely stating that as an accounting policy will not make an accounting policy which is incorrect a correct policy. So if it is an accrual concept, even proprietorships, partnerships, they will have to create that provision for the long-term employee benefit gratuity. From this forum, again, I'll repeat, because we are seeing that sometimes accounting tax, income tax or indirect tax, that comes into our mind, and we are swayed by the tax laws and forget what should be the real accounting principles in the case of accrual concepts. So hence my request that please comply with this, so that the financial statements are reflecting true and fair view on the accrual basis.
Yes,
sorry to add in between.
We actually echoed your thoughts, and we had debated a lot on this, and we were very loud and very clear that wherever there is a non-compliance, the auditors will need to qualify their report. So we had a lot of discussion around this. Pramod.
Great. Sorry, I missed out that. Thank you.
Perfectly fine. Yeah.
Thank you, Sri Vishal Doshi ji and Sri Praveen Kumar ji, for this series, web series on financial statement of non-corporate entities and LLPs regarding the recognition, measurement, and presentation of liabilities. Now over to CA Abhay Chhajer ji and Pramod Kumar ji for the concluding remarks.
Abhay ji.
Thank you very much, Rajesh ji. I think an excellent interaction. I'm sure the participants here would have been immensely benefited with the questions raised, deliberated, and I think so practically answered. I'm sure the members, participants would really be, were able to understand the real in-depth and, the reason of having this webinar series. The reason was that whatever has been properly reflected, of course, you've been doing in past, but I think more important is the non-corporate entities, which were actually, I would say, before releasing of these formats, were little unorganized, different formats may be followed. And I think I echo the words of Praveenji that this is so important, not just for the audited, but for the unaudited financial statements. Every statements now, going forward, even the regulators once, because we've been trying from the ASB that even regulators, banks, companies, whoever takes these financial statements would have a standardized and a uniform financial statements prepared for non-corporate and LLPs. If not done, I'm sure they'll go back to the preparers, they'll ask the auditors and ask the preparers to prepare in the format which is issued by ICI and by the Accounting Standard Board. I think that is the day we are looking at, that every formats comes in these formats. And thank you so much, Praveenji, Vishal Bhai, and I think excellent, I would say, session, very practical. I'm sure the members, participants would have been really benefited. Rajesh Bhai, once again, thank you for an excellent moderation. Your time always, it's a big support for ASB for any webinar whenever you are available. I think those questions which comes from the audience or from the participants really helps each one of us to understand the basic and the in-depth understanding of these financial statements preparation and these framework. And I believe for the members, just to share with you, if you go to the asb.ici.org website, you will go to a section called What's New. When you go to that section, What's New, you will find a lot of new things which has been added. In that, you will find those Excel formats which Vishal Bhai was mentioning, that these Excel formats for non-corporate entities, LLPs, and even technical guide and formats for non-profit organizations are available. So please have these downloaded with you, use them, share it with the preparer, and ask them to prepare in this financial statements the formats which been used for 23-24. Of course, applicability 1 for 24 is as per the guidance note, but like Vishal Bhai mentioned, that it is so important that should have been done for even 22, 23, 23, 24. But certainly would request everybody to start having these formats, use these formats, start preparing. And these are excellent formats which are prepared by ICI and very useful for each one of us and very simple, I would say. And even for the disclosure requirements, you'll find a lot of benefits which were earlier not being disclosed. Now you're able to do it in these formats. So thank you, Vishal Bhai, Praveen Bhai, once again, Rajesh ji, and of course the chairman, ASB, Pramod ji, for initiating this very important webinar. And we'll have another webinar tomorrow and day after, where members would really be benefited with the experts, which again will be deliberating on the income, expenses, and other important aspects of these financial statements. So thank you all the participants for joining today, and I'm sure we had an excellent learning. We'll have more such learning going forward through the ASB. Thank you very much.
Thank you so much.
Thank you, Praveen ji, Rajesh ji, Abhay Bhai, Pramod Bhai.
Thank you, and thank you, Shalini, the office IT, for ensuring smooth, execution of this webinar.
Thank you, everyone.
Good night.
Thank you. Bye. Good night.